In the first half of 2022, inflation moved up dramatically all over the world. It reached levels we had not seen for decades. Developed nations and emerging countries were all affected by this process. When Russia invaded Ukraine in late February, very soon, the war became the official reason for high inflation. But if we dig deeper, it soon becomes obvious that the conflict is just a convenient scapegoat. The real answer is much more complex. Let's see if we can unpack it. As always, to understand what's going on, we have to go back in time at least a few years. In this case, the 2008-2009 financial crisis should be our starting point, during which consumer demand disappeared, the housing and credit markets imploded, nobody wanted to take out a bank loan, and many felt that a total collapse of the global financial system was near. Traditionally, central banks had responded to similar situations by reducing key interest rates, making credit cheaper, and thereby boosting consumer demand, gradually restoring confidence in the system. In this case, short-term interest rates were cut to zero, but this was not enough, so central banks also unleashed quantitative easing, which had been tested in Japan but had never been tried in the West. With QE, central banks started purchasing government bonds and mortgage-backed securities in order to stabilize the market, push down long-term interest rates, and further encourage lending. In the following decade, all the major central banks kept buying more assets, for which they provided bank reserves, increasing the money supply and injecting huge amounts of liquidity into the system. They thought that with the massively increased reserves, banks will start lending more, giving a boost to the financial system, restoring confidence, increasing inflation, ending the recession. Almost immediately, projections of hyperinflation appeared all over the internet and mainstream media. Many thought that QE was simply money printing, which will lead to an even bigger catastrophe. The recession soon ended, but inflation was stuck below the official target, which was 2% in most developed economies. Banks were able to lend more, but people simply didn't want to take out loans because they still had financial and other pains. Credit had never been this cheap, but instead of investing in new projects, companies started buying up their own shares, which was a logical way of spending all this cheap money. At least, they kept more profit for themselves instead of paying it out to the investors. The crisis had other, perhaps more serious effects though, as in many countries the demographic trend worsened and never really returned to its previous base. People slowly got used to the new normal. Asset prices started going up to unseen levels thanks to the unprecedentedly cheap credit we now had in the economy. We can say that new bubbles were inflated in several key areas, or that one gigantic, never-before-seen bubble emerged that encompassed every asset class. The stock market continued to go up, breaking to new highs, and a new craze appeared, that of cryptocurrencies, that promised a new era of decentralization. However, most of the time, they were simply used in speculation, as more and more market participants jumped in, further increasing crypto prices. The housing market never really returned to the craziness of 2006. Lending requirements remained stricter, so we could be fairly certain that the next crisis would not start from there. In the meantime, due to an OPEC decision, oil crashed. By early 2016, it broke below $30, which reduced inflation, but at least it helped those countries that relied on imported oil. By 2018, confidence returned, prices continued to go up, and inflation finally broke through the desired 2% level. QE more or less ended, so central banks could now discuss quantitative tightening, which was to have the opposite effect, reducing their amassed assets and removing liquidity from the system, making it somewhat harder to lend. There was some scare in the markets, but things remained the same until early 2020, when the COVID pandemic caused a selling craze. By April, all markets had crashed, as governments intentionally tried to shut down the economy by imposing restrictions on travel and social interaction. Instead of a gradual recovery, we had another crisis, although this played out much faster than usual, and by August the market recovered, even though most restrictions stayed with us. The enormous drop in GDP, 31.4% in the US in second quarter 2020, was soon corrected by a similar growth rate. Oil prices that reached new lows during the early months of the pandemic, and at one point went below zero on certain contracts, once again shot up to $50 a barrel. However, when it came to central banks, this time it was different. Besides monetary measures, like cutting interest rates to zero from a mere 2.5%, the fiscal policy also changed. Direct stimulus was applied in the form of government investment programs, enhanced unemployment benefits, loans and guarantees to small businesses, the suspension of loan payments, and even direct payments to individuals. Unlike in the previous crisis, free money was handed out to millions of people, not just in the United States, but other countries as well. Through these steps, consumer spending was restored, inflation soon started to go up again, proving that such direct fiscal measures are much more effective in combating disinflationary trends. However, the consequences would also be more severe. 2021 showed consistently rising inflation, reaching 2% again in the US in March, then spiking to 7% by the end of the year. Tensions between Russia and Ukraine were rising. We heard news regarding the massing of troops near the border, but there was no war yet. This level of inflation in developed economies, that had not been seen since 1982, was already with us, and while people had complained about rising prices throughout the previous decade, they had not seen nothing yet. After the Russian invasion in late February 2022, a series of sanctions were delivered by the US, the EU, and various other states. These targeted Russian companies, their products, and key individuals, but also limited the export of Western technology. Eventually, even natural gas and crude oil were included in certain measures, although this ran into serious opposition in Europe, where several countries were heavily dependent on Russian deliveries. By July, we had reached a point where Western European countries were begging their population to conserve energy because the missing Russian shipments could not be replaced with American or other alternative sources. The war affected grain deliveries as well, leading to a serious increase in the prices of bread and other foodstuffs. In countries like Hungary, inflation reached 11% and continued to rise, while overseas, signs of slowing could already be seen. Politicians overwhelmingly blamed the conflict for the process, which represented a serious problem for hundreds of millions of people, but this was largely false. As I have already explained in this video, monetary and fiscal measures led to the dramatic rise in consumer demand, which then caused price hikes and a serious shortage of components in the IT and automotive sector. The war was indeed a convenient excuse. Western sanctions simply exacerbated an already strengthening inflationary trend. The conflict will likely continue, as neither side is interested in ending it. I should mention that the two sides are Russia and the United States, while Ukraine is just a battlefield where these two great powers fight for supremacy, similar to Syria, where the fighting had originally started back in 2011. We don't know what will happen in the next 6 to 12 months. Inflation may continue to rise, or it could revert to lower levels, eventually leading to another crisis as the now much higher interest rates gradually choke the economy. This is what had happened back in 2001 and in 2008. One thing is certain though, our political leaders will continue to blame the war for everything because it's more convenient than admitting that their own previous decisions led to rising inflation and more financial pain. I hope you found this video informative and helpful. Thank you for watching. See you next time.